Gold is money. It is not an investment. Now, what I mean by that is that if you acquire physical gold, it must be with the intention to eventually spend it, not trade it in. This is a very important distinction. Most people who buy gold in an ETF or something like that, they view it as a hedge, maybe, against the declining situation. But essentially what they're doing is they're doing exactly the same thing they do with Bitcoin. They're looking at it, I can buy gold, say, currently at 1736. I think it's going to go to 2000. So I'm going to buy it so I can sell it at 2000. That is not the purpose of gold. Gold is money. It is there to be spent. And to put this into context, as JP Morgan himself said, and I think in Congress, in a speech to Congress in 1912, money is gold and nothing else. All the rest is credit. And he wasn't stating an opinion. He was stating a legal fact, which is still true today. That is the way you've got to look at it. Mm-hmm. Now, we are where we are with a number of factors behind it. We have seen in the last few weeks, last week or so, 2 weeks, various senior traders on the precious metals desk at JP Morgan be found guilty of criminal offenses, spoofing, manipulating the market. We saw something which came out from Peter Hambro, who worked in the bullion markets going back, I think, into the late 70s. And he stated quite clearly, and he was in the loop, and he knew all about this, that the Bank of International Settlements, following the end of the Bretton Woods, pursued a campaign working with major central banks to suppress the price of gold. The whole reason that futures markets and the LBMA forward market evolved was to create artificial supply to take out demand for gold. And this was a point that Peter Hambro made. So what do we see today? We see JP Morgan, and also to a lesser extent Citicorp, are the two major means whereby the US government has been suppressing the price of gold. Now, I'm not saying that the price should be any different from where it is. I'm just saying that this is what has been happening. If we see this suppression diminishing, and I think it might be diminishing a little bit because it's no longer makes any sense for banks who have been rumbled to continue to do this to the same extent that they have in the past. They might have to find other means to try and sit on the price of gold. I suspect that the outlook for gold might improve just from the point of view of that suppression being diminished. The other problem with it, of course, is that the longer you suppress the price of gold, the more you give the opportunity to foreign central banks, particularly in Asia, to accumulate physical gold, which is what they have been doing. So actually, on many sense, the original purpose of suppressing the price of gold was to allow the dollar to fulfill its void, if you like, as the reserve asset on bank balance sheets. That situation has passed. So really what we're looking at now is the need to suppress gold, because if the gold price rises, it undermines credibility in the paper currencies. So that is a different thing. And I think that's why it has continued, but probably why it cannot continue in a sense. So I think that is, if you like, that background. Accepting that the whole point of hoarding gold, physical gold, holding gold, is that it is money and it is to be spent, then if you couple that with the regularity of banking crises, and the next one coming up, which we are on the verge of, as we've already discussed, is likely to be extremely severe, what I would see is crisis first, and I would see the reaction in the gold price second. I would put in a slight proviso, and that is that virtually everybody in the financial system, except perhaps the people who watch this sort of video are pure Keynesian economists, and they're driven by macroeconomic theory. And they do not understand that gold actually is legal money. They do not understand the consequences of the public rejection of a fiat currency and how that really does just remove its value entirely. They think that's something that only happens to the Venezuelans. It can't happen to the mighty dollar. And they invest on that basis. So you can see that they are not going to drive the price of gold down. So the first reaction to a banking crisis is probably for money to go into the dollar and short-term US government paper, not gold. And we saw this indeed when the Lehman Brothers failed. We saw the price of gold fall. I can't remember the figures, but I think it went down from something like 830 to 680 or something like that. I mean, it was a fairly sharp fall before it then went up to 1920 over the next couple of years. So this is why you should never, ever buy physical gold as an investment, because you will get whipsawed. There are people out there far bigger than you. It is a huge market, and they are on the other side of the transaction. They will shake you out. And, you know, even if you've got a few tens of millions of dollars to put into gold, you will get wiped out if you look at it as an investment. That has been the history of it. But if you have the physical stuff and you just tuck it away and you say, eventually I'm going to spend this if the whole economy goes, as the Australians say, tits up, then that will be the point. You will have learned the lesson and you will have done the right thing.
If you enjoyed this video clip, click here to watch another one you should like.